Kothari Petrochemicals just delivered its best ever profits, so why is nobody talking about it? With a near monopoly in a high-margin product and zero debt, this small cap is quietly compounding value while flying under the radar. Welcome to this deep dive on Kothari Petrochemicals Ltd, a niche petrochemical player with over 90% market share in polyisobutylene. With expanding margins, a rock-solid balance sheet and smart capital allocation, KPL is a potential long-term compounder, but it's not without risks. Let's decode the full picture. Kothari Petrochemicals, part of the HC Kothari Group, is India's only domestic producer of polyisobutylene or PIB, a specialty polymer used in lubricants, adhesives, and sealants. Established in 1989, KPL operates a 48,000 MTPA plant in Chennai, with key clients like IOCL, Lubrizol, and Infineum Singapore. Over the past 5 years, KPL doubled its revenue and grew profits by over 39% CAGR. FY 2024 marked its highest ever top line and bottom line, Rs 603 crore in revenue and Rs 63.8 crore in net profit. The company has delivered ROCE above 22% with no equity dilution and expanding free cash flows. KPL leverages a durable moat, scale, location advantage near CPCL, formula-linked pricing, and long-term B2B relationships. It's now expanding into high-reactivity PIB for better margins. With minimal domestic competition and regulatory barriers in place, the moat is narrow, but deep. Promoters hold 71% equity, none of it pledged. KPL is debt-free, funds capex from internal accruals, and maintains a consistent dividend payout of 40–50%. Governance is clean, with no red flags in audit or related party transactions. The balance sheet is fortress level, zero debt, Rs 85–90 crore in cash. Operating cash flows have consistently outpaced profits. Credit ratings stand at A+ and A1+, reaffirming strong fundamentals. PIB remains the core, offered in conventional HR and specialty grades. FY 2023 saw a capacity jump from 36K to 48K MTPA. Future plans include backward integration and expansion into new PIB variants for plastics and cables. KPL supplies directly to industrial buyers, cutting intermediaries. Exports, though just 14% today, are rising, especially for HR PIB. Logistics are lean, and proximity to ports and refineries enhances efficiency. FY 2024 EBITDA margins hit 15.9%, the highest yet. Thanks to formula-linked pricing and product mix upgrades, the company has built resilience despite raw material volatility. Double-digit PAT margins are now a norm. At Rs 147 per share and a market cap of Rs 100 crore, KPL trades at ~15.5x FY 2025 E-earnings and ~11.6x EV/EBITDA. Compared to peers, it's attractively priced given its balance sheet strength and earnings visibility. Product concentration is the big one, 100% revenue from PIB. Also, raw material dependency on CPCL and RIL and export exposure make it vulnerable to disruptions. Lack of downstream diversification caps scalability. Kothari Petrochemicals is a niche, debt-free compounder with expanding margins, sticky clients, and prudent management. Key metrics to watch: export growth above 20%, HR PIB traction, new product announcements, and continued earnings momentum. KPL checks 85–90% of Dr. Vijay Malik's quality filters on profitability, capital efficiency, debt aversion, and governance. Gaps remain in ESG disclosure, global presence, and diversification. What could change the game? Forward or backward integration, greater export penetration, and ESG upgrades. Until then, this remains a stable niche player slowly evolving into a growth plus innovation story. This video is for educational purposes only and should not be considered investment advice. Thanks for watching. If you found this insightful, don't forget to like, subscribe, and tap the bell icon for more company deep dives.